Hey everyone, I'm Jeremy Szafron. You're watching Kitco News. Well, we got the latest PCE inflation report just out, and it's a bit of a mixed bag. The headline inflation figure fell to 2.2%. It's a step closer to the Fed's 2% target, which sounds like great news. However, core inflation, excluding food and energy, remains at 2.7%, showing that price pressures aren't entirely behind us. Now, this leaves us wondering if the Fed's aggressive rate cuts are truly working or if we're simply buying time before the next economic wave hits. This inflation news comes on the heels of the Fed's recent 50 basis point rate cut, the largest in years, which is keeping risk assets like equities and gold on edge. Spot gold remains near $2,700 US, of course, bolstered by lower interest rates and geopolitical tensions, while the US dollar faces renewed pressure as investors brace for what could be a prolonged easing cycle. At the same time, silver, platinum, and palladium are being boosted by a more optimistic economic outlook driven by these rate cuts. But with all this in play, are we truly seeing a sustainable recovery, or is this just a temporary shift driven by short-term liquidity? Well, let's find out. To help us break it all down and navigate these choppy markets, I'm joined by Chris Gaffney. Of course, he's the president of world markets at EverBank. Chris, welcome back to Kitco News. Great to have you back.
Thanks. It's great to be here.
Okay, let's break down this PCE number. Obviously, it's showing that the report of 2.2%, it's getting closer to that 2% target that the Fed always talks about. How significant is this drop in inflation for future Fed decisions, especially given that core inflation is still at that 2.7%?
Right. There's a big question on whether the Fed was going to stay aggressive in another 250 basis point cuts this year, or will they scale it back to a quarter? This report really doesn't give us an answer to that. I think investors are going to turn to the next big data point, which is next week's jobs numbers, to see where that number comes in. But right now, the softer beat on the core, are the softer on the headline and worse on the core. It was a mixed bag on the PCE this week.
Yeah, I guess the question is, is the Fed truly making progress here, or are they simply buying time with these aggressive rate cuts?
Yeah, and a lot of people thought they were a little late to the game on starting the cuts, and how aggressive they were going to be going forward. I think inflation is moving in the right direction. I think that some of the factors that led to the higher inflation are gone now. So I do think we'll see it continue to ease out. So I do think, I'm a soft landing guy. I think we're going to see that glide path down to a soft landing, but there's risks, on the other side too. So you always have to protect your portfolio.
Yeah, of course. And as you mentioned, we'll be keeping an eye on those job numbers next week, especially the revisions too. Okay, well then before we switch over to gold and we talk about some of the equities and assets, let's talk about whether or not you think they're going to give us 50 for the next meeting. I mean, the market's pricing in another 50 basis point cut. Could this, aggressive measure lead to a resurgence of inflation later this year?
It certainly could. And that's the biggest risk, is that, when they start cutting rates, we'll see inflation pop back up. I think he's going to back off to a quarter. I don't see another 50 basis points at the next meeting. I think they'll back it off. They made their statement with the 50 basis points. And I think that depending on what happens with the jobs market, if jobs remain fairly strong, if we don't see a big miss on the jobs numbers, I think they'll go with a quarter.
Yeah, it'll be certainly interesting to watch. Okay, let's switch over to gold. I mean, you've been consistently bullish on gold, and it's obviously benefited from these falling interest rates, a weaker U.S. dollar. How does this new PCE data affect, your bullish outlook here for gold moving forward?
I'm still bullish. I think that we're in the beginning of a sustained rally still. I think it's going to continue, and so. The PCE numbers, were a little softer. I think like I said, I think the Fed's going to continue on their rate cut path, and that's going to help gold. Gold's also benefited from geopolitical tensions, which actually are increasing right now, and risks associated with the Middle East and the Ukraine. So I think that those factors continue to support the price of gold. And also, a weaker dollar. As the Fed cuts, that kicks one of the legs of the stool that's been supporting the dollar out from under it. So I think the dollar is going to continue to fall, and that's another factor that will support the price of gold.
Right. Yeah, geopolitical tensions, you mentioned it, especially in the Middle East. We're obviously keeping an eye on what's happening in Beirut and in Lebanon today. They've historically driven gold prices higher, but with these recent escalations, do you see this impacting precious metals over the next few months? Could we see gold surpass 3,000 if tensions worsen, or do you think that the risk premium is already priced in here?
I don't think it's fully priced in. I think that, if we see an increase in tensions, certainly I think you could see, we're just now seeing it shift. The buying earlier this year was more central bank and large purchases. We're seeing a shift towards retail right now. And I think the geopolitical tensions and the worries about the war is certainly something that will encourage individuals to purchase the precious metals. And so as that shift continues, I think that we could see further rallying and further demand on the retail side.
Yeah. When you factor in global unrest, is gold still the best hedge, or should investors be considering a wider range of hard assets to protect their portfolios?
The other precious metals, silver, platinum, palladium, the industrial precious metals, I think still have some catching up to do. So, in that regard, I think we always suggest that people stay diversified and have a little bit in all sectors, a little bit invested in a lot of different asset classes. But on the precious metal side, I think silver, platinum, palladium, because they're industrial, because we're seeing a global recovery with the exception of maybe China, I think that those industrial precious metals will be good. Hard assets are a great hedge in times of uncertainty, especially geopolitical war uncertainty. That the precious metals serve as a great hedge against that.
Yeah, it's interesting. Let's break open a little bit and talk about plat, silver, palladium. It's been so interesting watching it kind of trailing behind gold's performance this year. Obviously, we have the Fed cutting these rates. Could industrial metals start to outperform? Talk to me a little bit about your outlook here, especially with renewed growth in the U.S. economy.
Sure. As I mentioned earlier, a lot of the rally at the beginning of the year was due to central bank buying. Central banks concentrate on gold, not so much silver and platinum and industrial metals. So as individuals start to take over the reins of the demand side, I think that you will see silver, platinum, palladium catch up. And again, because of their industrial uses, a stronger economy will actually help on the demand side. And also, a scale back on the EV side, on the automobile with platinum and palladium in particular, less demand for those electric vehicles. We see continued demand and continued manufacturing on the gas and diesel. And that will continue with, increasing the demand for platinum and palladium. And even with the increase in electric vehicle sales, we're still seeing a shortage on platinum and palladium. They typically are in a deficit position. So I think that platinum and palladium are set up for a nice little run here, and silver even on catching up to the performance of gold.
Yeah, interesting. It would make sense. It is cyclical. Do you see that maybe the current gap between gold and silver is a buying opportunity? What prospects would these industrial metals, if inflation reaccelerates, I guess my point is it still a good hedge here? Is it still good to hold this?
Yeah, that's the thing about that. That's why we're set up so well right now for the precious metals. If the Fed's wrong in cutting rates and inflation runs, you've got an inflation hedge. You've got a hard asset inflation hedge. On the other hand, if they're right and we see them continue to ease back on interest rates and it creates a global economic recovery and acceleration in global economic activity, that's going to help the precious metal, the industrial precious metals, silver, platinum, and palladium. So I tend to think that at this level, silver, platinum, palladium are better buys right now than gold. But I think you're going to see a sustained rally across the board, especially if we continue to see rate cuts and the geopolitical tensions continue.
Yeah, well, speaking of rate cuts, the U.S. dollar has been significantly weak following the Fed's rate cuts. With PCE data in hand now, do you expect the dollar to continue its downward trend, or could we see maybe a recovery or rebound here?
Yeah, I think you'll see it, with the PCE number. I think a lot of people were thinking 2 more 50 basis point cuts. I'm not sure that this report will allow the Fed 2 more 50. Like I said, I think it's going to back them off to 25. I think that the immediate reaction after the 50 basis point cut was a sell off in the dollar, and then it pulled back a little bit. It's going to be up and down. I think the trend will be for a weaker dollar still, but meanwhile, I think you could see some dollar strength, or at least a leveling off of the dollar. It's not going to be a straight drop, and so it's going to be volatile going in.
Yeah, Chris, talk to me a little bit. I mean, there's been a lot of focus on precious metals, but what's your take on U.S. equities? I mean, we got the Fed cutting rates aggressively. Could stocks continue to rally, or do you think that there's just too much economic uncertainty for a more sustained upward trend?
I'm going to sound overly bullish on everything, if you will, but I'm a fan of the U.S. economy. I'm a fan of U.S. stocks, but even more so maybe of, if we see the dollar continue to fall, it makes some of the overseas stocks, some of the overseas equity markets look fairly attractive also. But I think the U.S. equity market, they were dominated by the AI, by the tech side. If we see a soft landing and a sustained recovery here in the U.S., I think you could see the stock market continue to recover and broaden out. The rally broaden out across not just the tech side. And let's get past the elections. We've got that big uncertainty coming up. I think we'll be choppy up until the elections, and once we remove that uncertainty, I think that sets us up for a more broad-based equity rally, especially if the Fed continues to cut.
Interesting. Yeah, no, it's going to be certainly, it's been such a fun little ride so far this year, Chris. When we go back to gold, I mean, you've been doing this for a long time. We got U.S. debt levels that are continuing to rise. We got this political uncertainty in the upcoming election you're talking about. Talk to me a little bit about these investment shifts from the retail and institutions towards things like gold. I mean, it's been quite fascinating to watch. You've mentioned those inflows. Have they just continued to increase? Are you getting calls?
Yeah, we are. I mean, the desk here at EverBank World Markets, we deal with individuals for the most part. We have some corporate clients, but most of them are individuals, and we're seeing demand and physical demand. They really want to buy the precious metals and have them shipped or have a store them for them, because they want something that's physical. They want something that they know they can get to in these times of uncertainty. And then the debt levels. I mean, that worries some folks. You're not hearing a lot about it right now, and I don't think debt levels are going to decrease anytime soon, especially with an election year. No matter who wins, I think deficit spending is going to increase even more so. So I think that the debt levels generally are going to rise, and individuals are worried about that. It's individuals. The economy is doing well. We're heading towards a soft landing, but I'm not sure a lot of individuals feel that way. There's still a lot of worries out there about the global economy and the debt levels.
Yeah, absolutely. You said it best. There's still that divide from Main Street and Wall Street, it feels like. Okay, before I let you go, what's the ideal portfolio look like right now in this type of a market? I mean, we're coming up to October already, if you can believe it. What does it look like? What do you advise?
Again, diversification. I think that, having 10 to 15%, 15 is probably high, into precious metals are non-traditional asset classes is smart for that diversification. Equities, bonds, I mean, evenly split to, I think an even split between the two right now, with the worries about, the global recovery. We know that interest rates are going to be coming down. So that should help bonds for a larger part, and they're kind of a core in the overall investment portfolio. So, I think even split equities, bonds, and then have some unrelated assets such as precious metals, some foreign currencies, some that are uncorrelated with those equities and bonds.
Right, makes sense. It's always nice to be holding a little piece of gold too, Chris. Chris Gaffney, president of World Markets at EverBank, joining us today to unpack all this. Hey, thanks, my friend. We'll continue to watch those job numbers next week, but hopefully we continue to get this data.
Thanks, Jeremy. Enjoyed.
Thanks, Chris. Appreciate it. I'm Jeremy Szafron for all of us here at Kitco News. Thank you for watching. As Chris mentioned, we're going to have lots of upcoming content with economic data to unpack, so stay tuned. We'll see you next time.